If we shift our resources away from evil empires and towards Starbucks, we can increase our profits fivefold.
Oh, just delicious. What's going on, money lovers? Welcome back. Today we're talking about Starbucks. This is one of my dividend growth stocks that I own. I'd be lying if I said I haven't had a tough time getting to this video to analyze Starbucks when every day I got these other stocks over here just being absolutely ridiculous. MindMed up another 20% today. Check out my video on that. NIO to the moon, another 13%. Palantir, 16%. By God, JR. These are probably my newest and probably most speculative holdings that I've picked up in the last 6 months. And oh my, the returns so far, if this continues. But I'll save those for another time. Let me know if you're interested in learning more about any of those companies, and I could try to answer your questions or make another video in the future. But anyway, back to Starbucks. So a few key metrics I wanted to look at for Starbucks include the PE ratio, which, as you can see, for the trailing 12 months is over 123, which is very high. There's a reason for this that I'll get to. I also want to look at the EPS. I'm not a big fan of EPS or earnings per share because it's too easy to manipulate it. You know, you can do things like share buybacks and show that your company's growing when it's really not. You know, you might be earning more money per share, but revenue could be declining. But I think it is still important to look at. It'll make sense later. I'm going to pull up some charts. Now, they are paying a solid dividend, and we'll talk about if they're growing it later in the video. And the other main things I want to touch on are their most recent earnings report for Q4 of 2020. We're going to look at whether we can consider Starbucks to continue growing. You know, is it considered a growth company or a dividend growth company? Who it might make a good investment for, and my price prediction for the company. And we're going to look at what they're doing in China, you know, if they are still expanding. As you can see here, Starbucks has done a lot of share buybacks from 2018 to 2019. The outstanding shares decreased by almost 12% from 1.4 billion to 1.2 billion. 2019 to 2020, another 4.17% decline. So they're buying a good amount of shares, and I'm curious to see if they're going to continue doing this. They committed to it early on when the pandemic had really just started. It'll be interesting to see if they continue this. Share buybacks can be good if done, you know, properly. I'd rather see Starbucks doing the share buybacks at the lows back in March and stuff like that. It does create value for shareholders, but I don't think buying back shares at all-time highs is an effective use of a company's cash. You know, buying it at an all-time high, that's something that the airlines just got in huge trouble for, because when the pandemic hit, they had no cash reserves, or not a meaningful amount, because they were spending it all on buybacks to keep, you know, pushing the stock price higher and higher. And how has this worked out for these companies so far? That number in the bottom right is in millions. So collectively, these companies have put nearly $50 billion into share buybacks. Some of them, in the most ludicrous examples, which I can't believe it's even legal, had to take debt out to do these share buybacks. They were literally spending more money than they even had to spend to do share buybacks to pump up the stock. I digress. That being said, a lot of Starbucks gains that I was able to get prior to the pandemic were in large part due to share buybacks. So I guess we have a love-hate relationship. It makes sense to do them when you think your company's undervalued, or like I said, if you're killing it and you're going to keep growing, fine, by all means. Getting back to what I said earlier, while earnings per share isn't my favorite metric, I think it gives you a good idea when you compare the PE ratio, the stock price, and the EPS together. So as we can see here, this historic chart on macro trends, you've got, you know, Starbucks' price, its earning per share, were increasing in tandem, and every time the price and the earnings per share would go up, the PE ratio would go down. So as you can see, from September 30, 2017, you had a price of $50, earnings per share of almost $2, PE or price to earnings was 25. Then at the close of 2017, December 31st, you had a price of $54 per share. The earnings per share had skyrocketed all the way up to $3, and the PE went down. It was at 17. Fast forward to what's happening now. Price has gone up quite a lot. The earnings per share has not. Even before, if we go before the pandemic here, December 31st, price of 86, EPS was about the same, and the PE was 28. And then you fast forward to now, if we go back to September 30, stock price is 85, earnings per share is all the way down to 79 cents, and the PE ratio is all the way up to 108. Now, obviously, their earnings were down a lot because of the pandemic, with everything being closed. The stock price has fallen out of alignment with the EPS and the PE ratio, and it's only gone worse. As you can see here, the price is somewhere around $97 now. PE ratio is 122, and the EPS for the quarter ending September 30 was 35 cents per share, almost down 50% year over year. So in theory, the stock price should also be down 50%, but the markets are irrational. Irrational exuberance has taken over with the prospect of these vaccines coming, which I don't think will be available to the whole population, let alone the population will want to take it for at least 6 months to another year. You could make the argument that 2020 really was a lost year. It's kind of a shame because they were doing so well. So where it is now, it's definitely a bit overvalued, and I would like it a whole lot more, probably in the mid 80s range. I would probably start buying more shares around $80 to $85, I would say. That being said, there are a lot of positives. Just wait to hear all the stuff that Starbucks is doing and my price target at the end of the video, which may surprise you. So we look at Starbucks dividend yield, its history, and the payout ratio. An annual dividend of about $1.80 or 1.86%, which is pretty good for a relatively new dividend. It's much more than you're getting in the bank. Their 3-year dividend growth rate is fantastic at 75%. The payout ratio around 63% for the trailing 12 months. I would ignore this because obviously their revenues were way down. I don't expect them to stay there. They've been able to reopen a lot of their locations. Now they've got 9 years of consecutive dividend growth, which is what you want to see. They're on their way to becoming a dividend aristocrat. As you can see, over the last 12 months, average dividend growth rate was almost 14% a year. During the past 3 years, it's been about almost 18%. And over the past 5 years, 21%. As a dividend investor, it's definitely a great company to own long term. That growing dividend rate is what you want to see. You could definitely get some nice capital appreciation. Great bang for your buck with yield on cost if they continue to keep growing. All right, now the last few things I wanted to touch on before we wrap this up. Their Q4 earnings report, whether they're still expanding internationally and mainly in China, and what my price prediction is for the company. So according to this article from CNBC, Starbucks is still repurchasing shares. They plan to repurchase 40 million shares through the end of fiscal 2021 with the possibility of purchasing an additional 16 million shares. So it'll be interesting to see if they go through with this. Repurchasing 56 million shares would keep them roughly at the same repurchase rate. Could mean that you continue to see Starbucks grow at a similar rate to the rate of growth it was achieving prior to the pandemic. And as things pick up, I'm curious to see if they're going to shift more toward this pickup and curbside pickup type of setup. So this is going back to Starbucks' second quarter. They opened 200 new stores, planned to open 300 in 2020, which is down from their original expectation of opening 600 new stores, and just to show you, the huge effect the pandemic has obviously played. Now, this will be interesting because Starbucks has historically played that third space, separate from your home and your office, where you could go and do some work, hang out. But if they're shifting toward this on-the-go strategy, because 80% of their orders seem to be on the go, it'll be interesting to see, how that affects the business model, whether it remains steady, if this is going to increase business, decrease it. That's something to keep an eye on. Or there's a possibility once the pandemic's over, we go back to normal, people go back to hanging out in Starbucks. Definitely a cultural shift to keep tabs on, because it's going to test whether, what's the biggest thing about Starbucks that draws people in? Is it simply their deliciously overpriced coffees that are fantastic? Or is it the Starbucks, ambiance? Do people enjoy going and sitting in a Starbucks and, oh God, I'm saying so much. You don't know. That's why you're listening to me talk. But it will be interesting to see how that plays out. I am going to guess people are mildly addicted to Starbucks' addictive frappuccinos, and they're not going to care whether they're eating it on the go or in the restaurant, and Starbucks will continue to meet great success. Here's a quote from the CEO basically addressing what I was saying about, Starbucks is a third place you go. You got your home, you got your work, you got your Starbucks. Hey, I'm drinking coffee here. All right, you ready for the fun stuff? Let's look at the Q4 earnings. Woo! But first, a word from Glenn here, who seems very bitter. Sounds like a small coffee shop owner whose business went under due to Starbucks' superior quality, fantastically overpriced coffees that, I'm sorry, we're all just going to keep drinking. There's no denying that. All right, I know the people are dying for the earnings report. You're dying to look at a bunch of numbers and charts. I know, I keep promising it. It's coming. Trust me. But first, talk about an elephant in the room. Starbucks just got over their latest hump of dealing with Luckin, who was scamming people into oblivion and was thought to be Starbucks' biggest competitor. Enter McDonald's and Starbucks' next challenge in China. That is some big news with the potential to disrupt Starbucks' China expansion plans. It'll be interesting to see how this plays out. McDonald's investing $400 million to expand their McCafes. Well, if America is any indicator, I'm sure we'll just have both able to exist peacefully. You want to get cheap hot water, you can go to McDonald's. You want your expensive and classy hot water, you go to Starbucks and pay 8 times as much. I'm sure both will succeed without getting in each other's way too much. So if we take a look at their Q4 earnings here, this is all directly from the report. We see that for their 2021 guidance, they're expecting global comparable store sales growth of 18 to 23%, US sales 17 to 22%, and international sales growth of 25 to 30%, and China comparable store sales growth of 27% up to 32%, which that's all good numbers. It's good to see that they're growing. Now we'll have to wait and see whether they actually go through with this. And they are planning to open approximately 600 new net stores in China, which is great to see. So there is room to grow still internationally in China, and definitely worth keeping an eye on. At the end of 2020, they had already opened 581 new net stores in China, with 250 new stores opened in the fourth quarter, representing a record level pace of store development for Starbucks China. So that's all good. They are expanding. You want to see them growing. So I think at worst, Starbucks will continue to grow, kind of like a blue chip stock, a few percent a year. In the meantime, you're going to get to collect this great dividend, which we know that they have grown significantly and plan to continue growing. So if you're a dividend investor, it's definitely a great company that could potentially fit your portfolio. That's one of the reasons I like it so much. It kind of gives me some diversity. Although it is technically, its classification changes. Some consider it a tech company. I consider it a coffee company that does tech things. It has a fancy little mobile app that sends me offers that keep me addicted and coming back. As you can see here, they are on Yahoo Finance. They have them as a consumer cyclical. I lack exposure to consumer, cyclical and discretionary type companies. I would actually put this as a consumer discretionary. I mean, let's be real. No matter what, people are going to be buying Starbucks. Not like buying a Porsche, even though it might feel like it after $5 coffees. Anywho, gives me some exposure to consumer. It balances out my portfolio because it gives me some nice dividend growth exposure while not tying me to a, underperforming typical dividend aristocrat where its growing days are over. Starbucks brings the potential for both growth and dividend income. So that's one of the reasons why I really like it. Another thing that's pretty interesting from their 2020 financial results. So as you can see here, obviously store growth and transactions were down with everything closed, but change in ticket price, which is how much people are spending per order, was up only 3% in 2019, but it went up 21% September 2020. So that means even though less people were coming in, the people that were coming in were spending more money. So it'll be interesting to see whether this trend holds, because then in theory, when everyone's going back again, if they're all spending more money, Starbucks is going to make a lot more, and there's your growth potential. All right, last but not least, my price prediction, which you're probably dying to hear by now. There's a few things I took into account here. Keep in mind that this prediction is not investment advice. This is just some little napkin math I did on if all goes well, if, best case scenario, if Starbucks does continue with the share buyback program, and they do continue to see significant expansion and revenues growing, I could see 150 to 180. And at worst, they're clearly still growing. Once the pandemic is finished, which looks like we're almost out of the woods, things go back to normal. Starbucks customers numbers return back to where they were prior, and maybe now they're spending a little bit more money on top of it. Add in the new stores that they're adding, opening up in the US and China. Maybe we even start to see more exposure internationally, and voila, you're going to have a growth story on your hands. So keep in mind, I just pulled these two numbers out of a hat. They're literally meaningless. What do I know? Starbucks will probably be bankrupt by tomorrow. So let me know in the comments below what you think of Starbucks. Are you buying or selling, and why? Let me know what companies you want to see an analysis of on the future. It's Vinny from the Investment Club, and I'll see you next time.